Today, bonds and how they work. Hello again, it's Martin North from Digital Finance Analytics, working latest posts covering finance and property news with a distinctively Australian flavour. I've had quite a few requests over the last few weeks to explain how bonds and the bond market works. Now, of course, years ago, I used to teach capital markets. In fact, I went all around the world doing so, teaching swaps and options and futures and bonds and all the other various types of capital market instruments to bankers around the world. So today, I'm going to use that experience to talk about the bond market. Of course, it's very relevant at the moment, given what's happening. I refer to my earlier show on this, which I made a couple of days ago. But first, let's just start with the global debt burden, which is estimated to be, at the moment, around $281 trillion US. And within that, the bond market is a critical element of the global financial system. It makes up nearly half of the total debt outstanding. In fact, as at August 2020, the International Capital Markets Association, or ICMA for short, estimates that the overall size of the global bond market in US dollars is around $128.3 trillion, and that consists of around $87.5 trillion in so-called SSA bonds, that's 68%, and $40.9 trillion in corporate bonds, that's around 32%. SSA, as we'll see later, is essentially states and other public entities. The IMCA is a not-for-profit membership organisation with around 600 members in 62 countries. Now, bonds can be issued by corporates and firms, and also by sovereigns, supranational and agencies, or as I say, SSAs. But beware that sometimes SSA can refer to supra, sub-sovereign and agencies, and here, in this definition, sovereigns, which is debt issued by countries, is not included. But in the figures I quoted, it's the total amount. And in fact, the SSA bond markets are dominated by the US at $22.4 trillion, China at $19.8 trillion, and Japan at $12.4 trillion. And between them, they make up around 62% of the global SSA market. Sovereign bonds constitute 73% or $63.7 trillion of the global outstanding SSA market. So a lot of it is issued by countries. In terms of country of incorporation, the global corporate bond markets are dominated by the US at $10.9 trillion and China at $7.4 trillion. And between them, they make up around 45% of the total global corporate bond market. 53% or $21.5 trillion of outstanding corporate bonds are issued by financial institutions. Now, of course, issuance has been booming in recent years and has accelerated as central banks cut interest rates and turned on the quantitative easing taps. But let's go back to basics. What is a bond in the first place? Well, a bond is a type of debt security. They are effectively an IOU between a borrower, the issuer of the bond, and a lender, the investor who purchases the bond. Just as a bank deposit is effectively an IOU between the bank and a borrower, and the depositor as a lender. When a government, a corporation or other entity needs to raise funds, they can borrow money from investors by issuing bonds to them. Investors who purchase a bond from an issuer are essentially lending money to the issuer for a fixed period of time, and in return, investors receive the bonds promising that they will receive interest payments or coupon payments at certain intervals, and also that they will have their principal returned on a stated future date. And that's the critical point. The end date is pretty firm, and the total amount to be paid back at that end date is also locked in. Fresh bonds are issued into what is called the primary market, while where the bond is quoted on a securities exchange such as the ASX, the investor can realise their investment by selling that bond to another investor at the current market price in the so-called secondary market. And issuers of bonds include banks and other financial institutions, corporations, governments, and quasi-governmental bodies and supranationals, like the World Bank. Investors include central and commercial banks, government agencies, international financial organisations, investment, hedge and pension funds, insurance companies, corporations, and in some situations even individuals. Corporates can raise funds direct from investors rather than via a lending intermediary, so this is an example of so-called disintermediation. In fact, many of the large investment banks will facilitate a bond issuance for a borrower and sometimes collaborate with a panel or syndicate of banks to underwrite the issue. They will generate fees from that transaction but won't generate interest returns. So here now is my formal definition of a bond. It's an instrument sold to the investor, incorporating a contractual obligation of the borrower to make payments of interest and repayments of principal on borrowed funds at certain fixed times. And the bond will also contain the conditions of default and all the other terms and conditions of its issue, which is contained in the agreement or indenture. Bonds are sometimes described as a capital market product since the maturity is over 12 months. There are also shorter term notes or paper, for example commercial paper, which I won't discuss today. But all you need to know is that a bond is essentially a stream of cash flows and evidence of debt. Streams of cash is a cornerstone of the capital markets, and here I need to introduce the concept of the time value of money. The time value of money is the concept that money you have now is worth more than the identical sum in the future due to its potential earning capacity. This core principle of finance holds that provided money can earn interest, any amount of money is worth more the sooner it's received. Of course, when rates are negative, that no longer holds, but that's a whole nother story. And it also means that you can assess the real value of a flow of cash over time with the future value, the current value, and the assumed interest rate, all essential features. Perhaps to explain this further, consider this. If I offer you $100 today or $120 in 2 years' time, which is better for you? Well, there are a couple of questions you might ask. First, what rate might I get if I took the money today and invested it somewhere to earn interest? And second, what is the risk that in 2 years' time I might not be around to make that payment? If rates are high, you might think that you could invest to get a better rate with the $100 today. But if rates are low, the future guaranteed payment might be a better choice, assuming, of course, I pay it then. Now, this all starts to get into the terminology of how a bond works. The bond face value, or par value, is the amount a bondholder will get back when a bond matures. The annual coupon rate is the posted interest rate on the bond. In reverse, this is the amount the bond pays per year as a dividend by the par value. And a small sidebar, we need to be careful to check for 365 versus 360-day calculations. That's a little trap for the unwary. The market rate, or discount rate, is the yield that could otherwise be received by buying another instrument. Generally, this will be different from the actual coupon rate on a bond. And then we need to consider the years to maturity. That's the number of years remaining until the bond pays out the face value. You may need to use decimals here, for example, 9 years and 6 months is 9.5 years, for example. And two final things to know are the days since last payout. That's the number of days it's been since the bond last issued a coupon payment. That's why the day count's important. And the coupon payment frequency, which is how often the bond makes a coupon payment each year. And note there are some bonds which pay no coupon and only pays out at maturity, and these are called zero coupon bonds. So with that introduction, let's now look at a real example using a bond simulator I built. So first, here is my simple bond calculator. And what I've done is I've put a par value, or face value as it's called, of $1,000. That's the amount you get back. The annual coupon is 5%, so that's the calculation on the bond. It's got 5 years. And I've also, for this particular starting point, assumed that the market rate is at 5%. And this chart shows you the effective cash flows. At the beginning, as an investor, you would pay out $962 to buy the bond. You would then receive, at the end of the first year, a coupon of $50. Second year the same, the third year the same, the fourth year the same, and in the fifth year you'd receive the final repayment of $50 and the capital repayment, which would be the face value, $1,000. And the net present value is essentially the current price, which is $962. So in other words, if you were to buy that today in those parameters, that's what you'd pay. But now let's change the market rate. Let's assume that rates have dropped. And let's assume they've gone down to 2%. Now you can see that immediately the price has risen. So as rates come down, the price goes up because the $1,000 in a few years' time is worth a lot more. So now the flow is you'd have to pay $1,123 to buy the bond. You'd still get the coupons over the 5 years, and you'd get your $1,000 back at the end of the period. And just to illustrate the point, let's put the market rate at 10%. Unlikely for many years, I guess, but it's interesting just to see what would happen. And in that situation, now, of course, the bond is worth a lot less because the coupon is 5%. That's a lot lower than the market rate, so the price has to adjust down. So now you would pay $754 to buy the bond. You still get the $50 each year by way of coupon, and you still get the $1,000 back at the end. And I would just say that this way of displaying flows, money in, money out, is one of the fundamental tools that I use when I teach capital markets to show the way the flows work. And interestingly, when I used to teach capital markets, I used to run a HP12C, which was a particular bond calculator that had all of those WYSI functions built in to be able to calculate the present value, the future value, and things like that. So that's my own edition of a bond calculation. Of course, there are also calculators on the web. Here's just one example that I found earlier on. And it does pretty much the same sort of things. So you've got the face value or par value, you've got the coupon rate, you've got the market rate or discount rate presented as 2% at the moment, years to maturity, and you can also put in things like the days since the last payment, the coupon payment frequency, and then essentially you can calculate the bond price. And you can see here in this example, with a 3% annual coupon with a market discount rate of 2% and 90 days since the last payment, the clean price is $1,047, whereas the dirty price or the market price is $1,054. But if you put the discount rate from 2% to 5%, well then it changes. We now have a dirty price of $920 and a clean price of $913. And if you put in a 10% discount rate, you get a dirty price or market price of $742 or a clean price of $734. So you can see quite clearly the inverse relationship between the market rate, which of course is the rate that you could potentially invest out elsewhere in the market, and the bond price. Remember the inverse relationship rule. So one of the critical things to understand is that the price of a bond has an inverse relationship to interest rates. When the cost of borrowing money rises, bond prices usually fall and vice versa. At first glance, The negative correlation between interest rates and bond prices may seem somewhat illogical, but as you look more closely, it actually makes really good sense. Perhaps an easy way to grasp why bond prices move in the opposite direction of interest rates is to consider that zero coupon bond, which doesn't pay regular interest and instead derives all of their value from the difference between the purchase price and the par value paid at maturity. Zero coupon bonds are issued at a discount to par value, with their yields a function of the purchase price, the par value, and the time remaining until maturity. However, zero coupon bonds also lock in the bond's yield, which may be attractive to some investors. So, if a zero coupon bond is trading at $950 and has a par value of $1,000 paid at maturity in 1 year, the bond's rate of return at the present time is actually 5.26%, which is 1,000 minus 950 divided by 950 times 100. In other words, for an individual to pay $950 for this bond, they must be happy with receiving a 5.26% return. Now that, of course, will depend on what else is happening in the market. If current interest rates were to rise, where newly issued bonds were offering a yield of, say, 10%, then the zero coupon bond yielding 5.26% will be much less attractive. Who would want a 5.26% yield when they could get 10% elsewhere? So to attract demand, the price of the pre-existing zero coupon bond would have to decrease enough to match the same return yielded by previous interest rates. In this instance, the bond's price would drop from $950, which gave that 5.26% yield, to around $909.09, which gives a 10% yield. So now that we've got an idea of how a bond's price moves in relation to interest rate changes, it's easy to see why a bond's price would increase if prevailing interest rates were to drop. If rates dropped to, say, 3%, that zero coupon bond with its yield of 5.26% would suddenly look very attractive. More people would buy the bond, which would push the price up until the bond's yield matched the prevailing 3%. In this instance, the price of the bond would then increase to around $970.87. Given this increase in price, you can see why bondholders, the investors selling their bonds, benefit from a decrease in prevailing interest rates. And those examples also show how a bond's coupon rate and consequently its market price is directly affected by national interest rates. Now, to have a shot at attracting investors, newly issued bonds tend to have coupon rates that match or exceed the current national interest rate. Bond rates are reported on an ongoing basis, of course, in the secondary market. And here's a recent 10-year chart for the Aussie. It can be quite volatile. And here is an example of an ASX report showing the latest bond issues, details of the bonds such as coupon and maturity, and the price variation. Remember, price and rates move in opposite directions. Now, let's talk a bit more about bond pricing. The price is essentially what's called the present value of all future cash flows. The yield to maturity assumes cash flows are reinvested at the yield to maturity rate. As interest rates decrease, the price of the bond decreases and vice versa. Fixed rate bonds may be popular when interest rates are expected to fall, as the price will rise. And they are usually quoted as a spread or margin over a risk-free security of the same maturity, for example, US Treasuries. The spreads may well change from time to time, depending on risks and volumes and all sorts of other things. And in terms of repaying the bonds, there are all sorts of methods, for example, being repaid right at the end, or being repaid in stages, perhaps by a lot or a pro rata basis, or even with a call or a put option exercised on the bond. And of course, an issuer can always buy their own bond back from the market. Now, there are several types of bonds issued in different markets, targeted at different investors. Firstly, let's talk about domestic bonds. Domestic bonds are discounted or interest-bearing securities issued in currencies of the country of issue and issued by companies resident in that country. So issues are looking for investors in the home market, and interest may be paid net of tax depending on local laws. For example, an Australian corporate issuing a bond in Australia. Then we have foreign bonds, and those are discounted or interest-bearing securities issued in a currency of the country of issue, but issued by foreign corporations or banks, which means that they're investors outside the home market. So, for example, an Australian company issuing a US dollar bond in the USA. Since investors in foreign bonds are usually the residents of the domestic country, investors find these bonds quite attractive because they can diversify and add foreign content to their portfolios without the added exchange rate exposure. Nevertheless, there are still some unique risks to owning foreign bonds. Because investing in foreign bonds involves multiple risks, foreign bonds typically have higher yields than domestic bonds. And foreign bonds carry interest rate risk. When interest rates rise, the market price or resale value of the bond falls. For example, say an investor owns a 10-year bond paying 4% and interest rates increase to 5%. Few investors will want to take on the bond without a price cut for offsetting the difference in income. Foreign bonds also face inflation risk. Buying a bond at a set interest rate means the real value of the bond is determined by the amount of inflation taken away from the yield. If an investor purchases a bond with a 5% interest rate during a time when inflation is actually 2%, of course the investor's real payout is the net difference of just 3%. And also currency risk is still an implicit issue for foreign bonds. When income from a bond yielding 7% in a European currency is turned into dollars, the exchange rate may, for example, decrease the yield to, say, 2% because of exchange rate differences. And note, however, that this risk is not explicit in the sense that these bonds would always be priced in dollars. And then we've got political risk. Investors should consider whether the government issuing the bond is stable, what laws surround the bond's issuance, how the court system works, and additional factors before investing. Foreign bonds face repayment risk as well. The country issuing the bond may not have enough money to cover the debt, and investors may lose some or all of their principal and interest. And there are many examples of foreign bonds, and here we'll just go over a small number of examples. A bulldog bond, for example, is issued in the United Kingdom in British pounds sterling by a foreign bank or corporation. Foreign corporations raising funds in the United Kingdom typically issue these bonds when interest rates in the UK are lower than those in the corporation's country. A kangaroo or Matilda bond is a bond issued in the Australian market by a non-Australian company. For example, in June 2016, Apple sold $1.4 billion in notes maturing in June 2020. In January 2024 and June 2026. Apple joined other companies such as Qantas Airways, Coca-Cola and Asiano in selling securities past the 7-year mark that had been the limit for many non-financial corporations in recent years. A samurai bond is a corporation bond issued in Japan by a non-Japanese company. In May 2016, French bank Societe Generale sold $1.1 billion in samurai bonds, including senior and subordinated bonds maturing in 7 years. The sale followed the Bank of America Corporation's $1.08 billion offering in a euro-yen format earlier that month. And just to mention that the senior and junior categorization signals the order in which repayments are made off the bond. Now, the third flavour of bonds is called a Eurobond. And a Eurobond is defined as a discounted or interest-bearing security issued in euro dollars or other euro currencies issued by banks or corporates or sovereigns or supranationals and sold to international investors. And the critical point here is that Eurobonds have no domestic markets, unlike domestic and foreign bonds. In fact, the history of the euro market and the prefix euro is a bit obscure, but it certainly dates back to the 1950s. And I think it has something to do with the fact that America helped to rebuild Europe following the Second World War. And dollars, which came out of the States, flowed into Europe, and being owned outside America were known as euro dollars. And in the 1960s, America ran balance of payments deficits, and so the US government tried to stem outflows of capital. So therefore, international borrowers were forced to look outside America for funds. In fact, the first US dollar-denominated Eurobond sold in 1957 by Petrofina. And it's a euro-dollar bond because mainly it's European buyers outside the US who bought, although it's denominated in US dollars. Now, the popularity of Eurobonds as a financing tool reflects their high degree of flexibility, as they offer issuers the ability to choose the country of issuance based on the regulatory landscape, interest rates, and depth of the market. They're also attractive to investors because they usually have small par values or face values, providing a low-cost investment. And Eurobonds also have high liquidity, meaning they can be bought and sold easily. The term Eurobond refers only to the fact that the bond is issued outside of the borders of the currency's home country. It does not mean the bond is issued in Europe or denominated in euro currency. For example, a company can issue a Eurobond denominated in US dollars in Japan. The first Eurobond was issued in 1963 by Autostrada, the company that ran Italy's national railroads. It was just 15 million euro dollars and designed by bankers in London, issued at Amsterdam Airport Schiphol, and paid in Luxembourg to reduce taxes. It provided European investors with a safe dollar-denominated investment. Issuers run the gamut from multinational corporations to sovereign governments and supranational organisations, and the size of a single bond issuance can be well over $1 billion, and maturities are between, say, 5 and 30 years, although the largest proportion have a maturity of less than 10 years. And Eurobonds are especially attractive to issuers based in countries that do not have a large capital market, while offering diversification to investors. The earliest Eurobonds were physically delivered to investors, and they're issued electronically through a range of services now, including the Depository Trust Company in the United States and the certificate-less Registry of Electronic Share Transfer in the United Kingdom, or CREST as it's called. Eurobonds are usually issued in bearer form, which means it's easier for investors to avoid regulations and taxes, and bearer form means that bonds aren't registered, and as a result there's no record of ownership. Instead, physical possession of the bond is the only evidence of ownership. And I'll put up a few examples just to illustrate what the bonds may look like. Now, the global bond market totals more than $120 trillion, as we said earlier. The fact many Eurobonds are unregistered and trade in bearer form make definitive numbers for the sector actually impossible to obtain. But it is likely that they account for around 30% of the total, and a growing proportion of Eurobond issuance is from emerging market nations, with both governments and companies seeking deeper and more developed markets in which to borrow. Now, bonds are often rated by rating agencies such as Moody's, Fitch and Standard & Poor's. The bond credit rating represents the credit worthiness of corporate or government bonds, and it's not the same as the individual's credit score. The ratings are published by credit ratings agencies and used by investment professionals to assess the likelihood of the debt will be repaid. And the credit rating agencies publish code designations such as AAA, B, CC to express their assessment of the risk quality of a bond. Moody's, for example, assigns bond credit ratings with a AAA, AA, A, BBB, BBB, CCC, CCC. And Standard & Poor's and Fitch assign slightly different ratings, but with a similar sort of scale. Now, these individual codes are grouped into broader classes described as investment grade or not, and in numbered tiers from high to low. In addition to the rating codes, agencies typically supplement the current assessment with indications of the chances for future upgrades or downgrades over the medium term. For example, Moody's designates an outlook for a given rating as positive, negative, stable, or developing. But just remember who is paying the agencies for their ratings, and remember that post the global financial crisis, it was clear that the rating agencies got the ratings of a number of significant issues completely wrong. And finally, if you are still with me at this point, I'll just describe in some more detail some of the key terms that are used in the context of bonds. The first one is accrued interest, the interest that has accumulated since the principal investment or since the previous coupon interest payment date, if there was one, has been made. Basis points means a 1/100th of a percentage point, or a 0.01%. 100 basis points therefore equals 1%. If a bond yield has gone up by 50 basis points, it's gone up by 0.5%, for example, from 4% to 4.5%. The bid, or ask, is the price offered by a buyer. The ask or offer price is the price offered by the seller. The bid price will always be lower than the ask price, except when there is a trade where the prices are equal and matched. Then there's something called clean price, which is the price of bonds not including any accrued interest. The clean price becomes equal to the market price immediately following a coupon payment. The coupon rate is the nominal rate the bond pays. The duration is the effective maturity of a bond and its sensitivity to changes in interest rates. When comparing two bonds, calculating duration makes it easier to tell which one to buy if each has a different coupon rate and a different maturity date. The market price is the price of a bond, including the interest accrued to the next coupon payment. This is sometimes referred to as the gross or dirty price. The nominal value is the CPI adjusted face value of the Treasury index bonds. The par is the face value of a bond at issue date. And the premium and discount, if a bond's price is quoted as higher than its face value, it's called a premium bond. If a bond is quoted at less than its face value, then it's known as a discount bond. And the yield to maturity, or the YTM, is the rate of return anticipated on a bond if it is held until the maturity date. The YTM is considered a long-term bond yield expressed as an annual rate. The calculation of YTM takes into account the current market price, the par value, the coupon interest rate, and the time to maturity, and it also assumes that all coupons are reinvested at the same rate. Sometimes this is simply referred to as the yield for short. So there you have it, a bit of a sketch of the bond market, and I think there are two things to bear in mind. The first is, as interest rates rise, bond prices fall and vice versa. And secondly, that bonds are a huge proportion of the total capital markets, and the rate of issuance has been accelerating recently thanks to recent developments in the financial markets and, of course, all the central banks moving quantitative easing levers up a notch. And by the way, if you'd be interested in me discussing some of the other capital market instruments like swaps and options and futures, let me know. I'll add it to the list. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.